By now, you know what each engine does. You know how they connect, you know how capital is supposed to flow between them, and so the natural next question is a simple one. How much goes where? And that is going to be what we're covering today. We're going to walk through the specific dollar amounts that the $1 million experiment uses for each engine. We're going to look at the contribution plan, how it's structured, and we're going to explain the key thresholds that change how money moves as the system grows. These are the $1 million experiment's choices. Your own numbers will depend on your starting capital and the approach that you choose for each engine, but the $1 million experiment gives you a concrete example to learn from. Now, before we get to the numbers, I want to address a question that almost always comes up at this point. If the income engine is the one that needs to reach $500,000 before it starts paying out income, why not put all your money into it right away? Get to scale faster. Then everything else follows sooner. Well, that sounds logical, but there is a reason we did not do that. And it comes down to something that much of investing education seems to skip over, and that is trading psychology. Learning how to trade is actually two separate things. There's the mechanical side, which is the setup, the entry, the stop, the exit, and a good mentor can teach you the mechanics in a matter of weeks. But the psychology, the psychological side, is a whole different story. Fear and FOMO, fear of missing out, are what destroy many new traders, maybe even most new traders. And they hit the hardest when the dollar amounts feel large. So, for example, a loss that represents 2.5% of a $3,000 account is $75. That stings a little, but you log it and move on. Now imagine the same percentage loss on a much larger account. Same percentage, much larger dollar amount. That emotional weight, before you have the experience to handle it calmly, is exactly what causes traders to break their own rules. And breaking rules is what blows up accounts. So, $3,000 happens to be the smallest amount that lets you trade one micro E-mini S&P 500 futures contract in the $1 million experiment's specific approach. That floor was set deliberately. The early months are as much about building trading discipline as they are about making money. You learn to take losses without flinching. You learn to resist FOMO. You learn to follow the method even when it feels uncomfortable. That discipline has to be built up at a small scale before you try to scale it up. Now, as for the growth engine, we start funding it from day one because the sooner you run it on real money, the sooner you develop the skill to operate it well. Stock selection, managing positions, handling assignments, these are learned through practice. The more time you have running the growth engine on real capital before the contribution phase ends, the better prepared you are to operate it at larger scale. And the accumulation engine gets a small direct contribution in phase 2 simply to give it a real role in the game from early on. The $1 million experiment does not need the accumulation engine to hit the $1 million target, but it is useful to start learning how to manage thesis positions while the rest of the system is still being built. The $1 million experiment's contribution plan runs for 12 months, $5,000 a month, $60,000 in total. After month 12, no more external money goes in. From that point onward, the system has to sustain itself through its own internal flows. So the sizing decisions in those 12 months really matter. Now let's start with the income engine because it gets the largest share of the early contributions. The income engine needs to reach $500,000 before it starts paying out income. Every dollar of trading profit before that point stays inside the engine and builds the account. So the faster we can grow the account, the sooner the income starts flowing. And that's why the income engine gets the most money in the early months. In phase 1, that's months 1 through 6, $3,000 per month goes into the income engine. That's 60% of the $5,000 monthly contribution. In phase 2, months 7 through 12, that drops to $2,000 a month. That reduction frees up more money for the growth engine and the accumulation engine as those engines need to grow their own base. Now, over the full 12 months, the income engine receives $30,000 in direct contributions. $3,000 a month for 6 months, $2,000 a month for 6 months, total $30,000. But the retained trading profits compound on top of that. So the actual account balance grows well beyond $30,000 by the time the contributions end. Now, why does the income engine start with $3,000 specifically? Well, I mentioned this earlier. In the $1 million experiments approach, trading MES futures contracts, $3,000 is the minimum practical starting size. It allows you to run one contract while keeping the risk at a level where you can stay calm and follow your method. If you use a different instrument or approach, your minimum starting size might be whatever that approach requires. Now, here is how the $1 million experiment's income engine scales as the account grows. For every additional $3,000 in the account, you add one contract. Each contract adds to your risk per trade and to your monthly income target. The percentage stays the same, only the dollar amounts change. At $3,000, you trade one contract. In the $1 million experiment's approach, that means $75 maximum risk per trade and a monthly target of $249. But at $6,000, that's two contracts, $150 risk per trade and a monthly target of $498. At $9,000, that's three contracts, $225 of risk per trade, monthly target of $747. And it keeps scaling from there. The key point is that the percentage ratios stay constant. What changes is the dollar size as the account grows. All trading profits stay inside the income engine until the balance hits $500,000. At that point, something important happens. 50% of the monthly trading profit starts flowing out as personal income to you. At $500,000, at the $1 million experiment's 8.3% monthly target, the engine is generating around $41,500 per month in trading profit. Half of that, roughly $20,750, becomes your income. And that is close to the $20,000 per month that the $1 million experiment is designed to produce. And here's the part that's easy to miss. The other 50%, also roughly $20,750, flows into the growth engine at the same time every month. So the moment the income engine crosses that threshold, the growth engine starts receiving approximately $20,000 a month on top of everything it's already generating. And that is when the system really starts to accelerate. Now, the $500,000 number is not sacred. It's a design choice. If you set the threshold lower, you start receiving income sooner, but the monthly amount will be smaller. If you set it higher, you wait longer, but the income when it arrives is larger. The $1 million experiment chose $500,000 because it felt like the right balance between getting to income in a reasonable time frame and making that income meaningful. Your own threshold is yours to choose. Until the income engine crosses that threshold, the growth engine is not receiving any transfers from it. The two engines are running in parallel. The income engine is building scale, and the growth engine is compounding its own base. They're not yet feeding each other. That changes once that threshold is crossed. The growth engine gets a smaller direct allocation than the income engine in the early months, but it has something going for it from the very first month, its own compounding. Now let me walk through how the growth engine's money flows, because it has two different things that going on at one time. First, the incoming money. In phase one, the growth engine receives $2,000 a month in direct contributions. In phase two, that goes up to $2,500 a month. Later, once the income engine crosses $500,000, approximately $20,750 per month also begins flowing in from the income engine. But that only happens once the threshold is crossed. In the early months, it is just the direct contribution. And second, there's the outgoing money. From the very first month, 10% of the growth engine's monthly return goes to the accumulation engine. This is not conditional on anything. It doesn't wait for the threshold to be crossed. It happens every month automatically from day one. Now, why 10%? Honestly, it's a somewhat arbitrary number. We needed a figure that would fund the accumulation engine meaningfully over time without taking too much away from the growth engine's own compounding. 10% felt like the right balance, but it's your call in your own implementation. If you want to invest more heavily in long-term asymmetric positions, you might set this higher, 15 or 20% or higher. If you want to prioritize the growth engine's compounding in the early years, you can set it lower. Just make sure that the rest of the system can absorb the accumulation engine's worst-case loss without being materially affected. The growth engine in the $1 million experiment uses the wheel strategy on quality companies. But again, that is our choice for our approach. The system does not require the wheel strategy. It requires systematic compounding that substantially outperforms passive market returns over time. How you get there depends on the approach that you and your mentor choose. One thing that's worth understanding about the growth engine's early performance is that until the income engine crosses $500,000, the growth engine is not receiving any transfers from it. So in the early years, the growth engine is growing purely from its direct contributions and its own returns. So the numbers are going to look modest in year 1 and year 2. That's expected. The curve is not linear though. It bends upward sharply once the income engine's threshold is crossed and the inter-engine transfers begin. The early phase is about building the base. The acceleration comes later. The growth engine compounds on whatever balance it holds. A larger balance produces larger absolute returns, and those larger returns send larger transfers to the accumulation engine. And so the whole system grows in a connected way. But it takes time for that flywheel to build momentum. Month 1's numbers look very small, but month 36's numbers look very different. One more thing worth saying here, the growth engine's returns will not be smooth month to month. Any approach involving equities are going to have up months and down months, and that's normal. The growth engine is measured over quarters and years, not individual months. Down months are not a sign that the approach is broken. They're just part of how equity-based investing works. What matters is the trend over time and whether the method is being applied with discipline. There's actually an upside to down markets in the growth engine. When equity prices fall, the same monthly contribution buys more. The wheel strategy, for example, lets you sell puts at a lower strike price, meaning you're agreeing to buy quality companies at an even bigger discount than before. When those companies recover, as quality companies tend to do, the positions that were built during the downturn generate stronger returns. The growth engine is not just resilient to market corrections. In some respects, it actually benefits from them, as long as the income engine keeps generating the capital to deploy. The accumulation engine receives money from 2 places, and neither of them is a direct external contribution, at least not until phase 2. The first source is the 10% of the growth engine's monthly return. This starts in month 1 and runs every month for the life of the system. In the early months, when the growth engine's balance is small, this transfer is a small dollar amount. But it is there from the start, and as the growth engine grows, so does this transfer. Now the second source kicks in, as I mentioned, in phase 2. From month 7 through 12, $500 per month flows directly into the accumulation engine as part of the external contribution. And the reason is simple. By month 7, the income engine and growth engine both have 6 months of runway behind them. They've built some scale. The accumulation engine, though, is ready to start doing real work. $500 a month for 6 months gives it $3,000 of direct funding by the end of year 1, on top of whatever has come in through the growth engine transfers. The key sizing rule for the accumulation engine is this: size each position consistently. Pick a dollar amount per thesis position and stick to it. Don't put more into the positions that you're most excited about. The portfolio works because of diversification across many bets and not because you sized up on your favorite one. The amount you choose per position is up to you, but just make it consistent. In the $1 million experiment, we're targeting an aggregate return of 20 to 30% per year across all accumulation engine positions. If the moonshot positions perform well, then the actual return may be higher than that. But 20 to 30% is the floor that we plan around. Your own target will depend on the types of opportunities that you pursue. The most important rule for the accumulation engine's overall size is one that we covered in episode 5. Size it so that even if every single position went to zero, the income engine and growth engine would keep running without any meaningful impact. The accumulation engine carries the most risk of the 3 engines. It needs to be small enough that its worst case scenario does not threaten the foundation. If it's too large and things go wrong, you might be forced to exit positions under financial pressure, which is exactly the opposite of the patient, long horizon approach that these positions require. Keep the accumulation engine sized as a bonus layer on top of a system that works without it. That's the right frame of mind here. The $1 million experiment does not need the accumulation engine to hit its $1 million target. The income and growth engines carry all of that. But when the thesis positions play out well, and some of them will, because that's the nature of a well-constructed portfolio, the accumulation engine adds meaningful returns on top of what the other two engines have already built. Now, everything we've covered today is the $1 million experiment's specific approach. $5,000 a month, 2 phases, $3,000 to start the income engine, $500,000 threshold, 10% growth through accumulation transfer. These are all our choices, but they're not the only valid choices. If you're working with less than $5,000 per month, the same logic applies, just at a smaller scale. Start the income engine at whatever the minimum practical size is for your chosen approach. Give the growth engine whatever you can while still giving the income engine a real base to work from. The accumulation engine will receive its share through the growth engine transfer from the start. Now, if you have more than $5,000 per month available, well, then you have more flexibility. You can build the income engine faster. You can start the growth engine base more quickly. You can even start accumulation engine contributions earlier. The proportions and the thresholds are all adjustable. The plan and blueprint spreadsheet on theinvestingproject.com is designed to be a configurable model. Change the inputs and watch how the projections change. It's a useful way to understand how different sizing decisions affect the long-term outcome. Now, one last point before we wrap up. The most common mistake people make when starting a multi-engine system is trying to run all 3 engines at full scale from day one. The result is that none of them has enough capital to work properly. Think about what this actually looks like. If you split $5,000 equally between the 3 engines, you'd have around $1,600 in each one. The income engine cannot trade a futures contract at that size. The growth engine cannot run a meaningful wheel strategy position. The accumulation engine cannot establish any real thesis positions. You've spread the money so thin that none of the engines can do its job. The system looks like it's running, but it's not really producing anything. And that is worse than having just one engine that actually works. A growth engine with $500 is not really compounding. An accumulation engine with $200 is not really building a portfolio, so scale matters. You need each engine to have enough to function before it can contribute to the system. And the sequencing the $1 million experiment uses, income engine first, growth engine alongside, and the accumulation engine last, that is not arbitrary. The income engine needs scale most urgently because its output is what eventually drives the whole system. Build that one first. Let the growth engine compound from whatever allocation is available alongside it. And then let the accumulation engine grow gradually through the growth engine transfer, rather than trying to rush it with direct funding before the foundation is solid. Now, the next episode is the final one in Module 1. We take everything we've built over these last 7 episodes and we walk through a complete month in the system from start to finish. Real numbers from the $1 million experiment plan, real decisions at each step, and a scorecard at the end. That's where the framework stops being just a concept and becomes something you can actually execute on. So remember to subscribe so you don't miss it, and we'll talk to you then.